Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did. Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How are you doing this morning? Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And you don't forget it.
Live from the broadcast studios of Andover Advisory Group, welcome to another edition of Talk Money. Thanks for tuning in. If this is your first visit, allow me to introduce myself. My name is Jeffrey Shank, owner of Andover Advisory Group, a registered investment advisor. I'm a chartered financial consultant, and we've been in business since 1996. We offer a comprehensive financial plans, and we help implement those for our clients. And our goal there ultimately is to offer good, sound financial advice for our clients. And we do the show here on a weekly basis for the most part. And the purpose of the show really is to give you some good information, some tips that will help you, actionable information, hopefully, that will help you to reach your financial goals. And ultimately, what it's all about is to improve your money IQ. So thanks again for joining us today. I do want to mention we've been doing this show for a while, and would like to you to visit the library. If there's some topics that you're interested in, there's a good chance that it might actually be already be in the library. Could be about taxes, could be about funding your child's college education or investing. Again, it's a good. There's life insurance.
Life insurance.
Yeah.
Waiting.
Can't forget to mention life insurance. Yeah.
Wait a second. Broadcast studios at Andover Advisory Group.
Yeah. So by broadcast studios, Lou, I mean laptop, headset, inconsistent camera angle.
That's fine. Yeah.
So we got a great show, I think, today. We're gonna talk about the inflation debate.
Ooh.
You know how transitory inflation is. We're going to talk about high deductible health plans, HDHPs for short, and of course this week's Talk Money tip. If you're a family with a son or a daughter who is entering their senior year of high school, you'll definitely want to listen to today's Talk Money tip.
Excellent.
But let's start out with the inflation debate. I think I got a slide here that shows the track of inflation over the last let's say 10 years or so. And in June of this year, the consumer price index shot up 5.4%. That's year over year.
Yeah.
Now they measure it monthly. They compare last month with this month to get a monthly rate. In many cases, they'll extrapolate that, but then they also publish the Labor Department publishes the year over year number. So that 5.4% number was year over year. So they compared June of 2021 with June of 2020, and this is CPI, the CPI-U, which is a subset of the entire consuming population, often known as headline inflation, right? That includes food and energy in that headline number, and then they take those out, those more volatile pieces, and they come up with a core number. I don't have the core numbers here, but that 5.4% was the highest inflation rate since 2008.
Wow.
And it kind of shocked people a little bit. And Lou, you know that I'm sort of insensitive to inflation at a personal level.
Well, you lived through the 80s.
Well,
Like-
I said insensitive at a personal level.
Yeah.
Because as you know, I don't typically buy the stuff on a daily
right.
basis, on a regular basis.
You're not seeing it.
I'm not seeing it personally in the stores. I did, however, short story. I did, however, did some shopping. I was asked to do some shopping during the pandemic, and
Like last year.
yeah, I did. I was asked.
Bragging about last year you did some shopping?
I did. Yeah. I insisted, however, on an efficient method of doing so, and asked for a spreadsheet with sortable columns so that I could just pick up everything aisle to aisle without having to search around for it.
Wait a second. You did the spreadsheet on your phone, or did you bring a laptop, or what did you do?
No. So, well, I created the spreadsheet and then accessed it via my phone.
Of course. Okay. Yep.
And you wouldn't be surprised to learn that I haven't done any shopping for the family since.
Okay. Yeah.
If I'm gonna do it, I want it to be. It's not an experience for me. It's a job to get done as efficiently as possible. That's just who I am. But anyway, getting back to inflation.
You got to look at it as more of an experience. You got to look at it as socialization. You got to look at it getting out of the house a little bit.
During the pandemic, I walked into the market.
Yeah, right. Yeah.
I walked into the market. I wasn't wearing a mask. I didn't note the arrows on the floor indicating which direction I was supposed to be going in. I was going the wrong way on a one-way aisle. Apparently.
So basically, you shop like an 80-year-old. Is basically what you're telling me.
You could say that, I guess, but I got some looks.
By the way, shop
dirty looks.
uptake in masks in grocery stores in the last 2 weeks, I'd say.
Yeah. I'm not surprised.
Yeah.
I mean, there's been a resurgence of new cases. It's believe it or not, I think they said beginning of September or August, there were more new cases than there was the same time last year.
Yep.
So, and I'm not surprised, and I've said this for a while, that just based on what I saw in China and Japan when they had their outbreaks, not the most recent one, but in prior outbreaks, where people just get accustomed to using them and they become more comfortable and they feel safer if they're wearing a mask when they're in public. So I'm not surprised to see people just putting on the mask and just to feel safer.
Yeah.
And it's become more commonplace.
Yeah, it's noticeable in the last 2 weeks or so that the number of masks have gone up considerably.
Yeah, but getting back to inflation, just for a couple of minutes. So we saw this 5.4% increase. You would probably know better, Blue, than me how that has developed over the last several months, over the last 12 months or so. But this has created this debate among economists and monetary policymakers as to whether or not this is something is this a trend that's going to be persistent over time and we have to worry about it, or is this just, as they say, transitory? And so we wanted to take a look today at the debate, from both sides, and those that are in the transitory camp, and that would include the Federal Reserve Chair Jay Powell, as well as the Treasury Secretary Janet Yellen. They attribute this to what they call the base effect. And so when you look at the chart and you look back to 2020, you can see that the inflation rate a year ago, I mean, we're at the height of the pandemic, and oil prices were really crashing. The economy sort of was shutting down, so to speak, and oil prices, gas prices, a lot of there wasn't a lot of demand,
Right.
and so prices fell, understandably so. And so the comparison here is year over year. So we're comparing June of 2021 with June of 2020.
Yep.
And so that base comparison, the base effect,
Right.
it was low. And so
This is
that-
regression. She was making the case this is regression.
this is a regression. Yeah, exactly. Yeah. And so, and they say that a lot of those factors that have fed into or caused this most recent rise in prices is temporary. Things like the fact that pent-up demand.
Yep.
People weren't spending a lot of money back during the pandemic, so their savings accounts blossomed, and they were looking for somewhere to spend it. Businesses were shutting down or cutting back, and it took a little bit of time for them to ramp up to meet that demand, and so prices went up as a result. And so what they're saying is that the combination of pent-up consumer demand and that those bank accounts, those healthy bank accounts, that's something that's only going to be temporary. It'll moderate some and get back to normal, and when it does, inflation will come back down.
No mention of stimulus.
Yeah, actually, yes, they have. Well, that's actually the other side of the debate, right?
Yeah.
So there are folks who feel that this is something that will be longer term, simply because because of monetary policy, primarily. The fact that the Federal Reserve has been pumping money into the economy for some time now, and then the fiscal policy of the federal government and the spending that was done during the pandemic and contemplated in the next year.
Yeah.
Another, I don't know, $5 trillion of additional spending. Although I think that's calculated over a 10-year period, Lo.
Okay.
I don't think there's going to be $5 trillion being injected into the economy, even if those stimulus bills are enacted. So that'd be $500 billion over 10 years or so. So the question is really, will that continue? Nobody knows for sure, but there does seem to be some lasting effects of monetary and fiscal policy that's been.
And I would respond to her, and this is totally anecdotal, but unlike you, I'm in the grocery store 2 or 3 times a week, and I buy the same thing, so I have a baseline. And while I would imagine that 5.4% over June of 2020 is expanded by the core value, the 2020 base rate, which was the economy was down, inflation was down. I understand that. It's still up because buying the same things over a period of time, it's expensive right now. And it's more expensive than I remember.
Do you have a number?
Do I a guess?
As to what those increases have been, relatively speaking, for the last year or 2 years? Because you're not the only person to say that. I get that from my clients all the time. Jeff, everything's up. They mention gasoline a lot, but
Sure.
I mean, I think that is
Me,
something
the grocery store has stood out. And I think I explained this a couple shows ago. Last month or the month before, I think it was last month or the month before, there were a couple times where I actually pulled off at the end of the checkout line and checked my receipt because I couldn't believe I couldn't believe the total on it. And like I said, I'm not buying new things. I'm buying the same things all the time. So you get in a routine, you get to understand what you're spending. And again, it's all anecdotal. I don't have a spreadsheet like you, but there are a couple times
See,
where
if you did, you could keep track of the prices,
true.
right? Just punch them in as you're buying the stuff.
Yep.
And then you could compare it year over year, and we'd have the Lou Blasi
Index.
inflation index.
See, I don't need that kind of stress in my life, Joe. And there's nothing I can do about it. You have to buy what you have to buy. But again, anecdotally, while okay, if she's going to tell me that 5.4% is high because of the low baseline of 2020, okay, I'll buy into that to an extent. But that's not the entirety of the story, I don't believe.
Yeah, I agree with you. And again, a lot of my clients have been complaining about the higher prices, and a lot of that having to do with their daily or weekly shopping trips. So the question is this something that we need to worry about longer term, or is it, in the words of Jay Powell and Janet Yellen, just a transitory effect that will moderate in the near future, and we'll get back to normal? And the question is, what is normal? Because the Fed's target for inflation is 2%. That's what their monetary policy, everything they do is targeting that 2% rate. But we have to keep in mind is that they don't use CPI.
Yeah, right.
The Fed uses a different measure of inflation that they call PCE. And the difference between CPI and the PCE inflation rate that the Fed uses is the PCE adjusts for changes in consumer behavior. For example, you're buying oranges on a regular basis, and all of a sudden orange prices take off for some reason. Well, you might hesitate and not buy oranges for a while and buy something else in its place. So the PCE inflation rate that the Fed uses takes out those abnormalities, if you want to call it that, and adjusts for consumer behavior. And not surprisingly, the inflation rate for the PCE is lower than CPI, or has been anyway.
Does it include fuel?
Yeah, it does.
Okay.
It does.
Now, you asked when you talked about it being transitory and when we're getting back to normal, and you asked what is normal. The question I had in my head is, what is transitory? In other words, define that term for me.
Yeah, great. Yeah.
Are they looking at the inflation rate calming down in the next half year, the next year, the next 5 years? What's transitory to them?
So I don't know
Yeah.
for sure what the official definition at the Federal Reserve is for transitory. My guess would be a 6 month, 6 months to a year period where we see a lot of these inflation pressures go away, because we get back to a normal economy. We get back to the supply chain problem goes away, because we're ramping up production for companies so that they can build cars because they haven't. I don't know if you've talked to any car dealers lately, but it's just crazy what's going on.
Car industry, the new car industry is just completely out of hand. Used car prices are up. Rental car industry has been shackled by this as well, because they cut their inventory during the pandemic, and now they can't get cars to refill their inventory.
Well, that plus a supply chain problem with parts.
Yeah.
They just can't get parts, and it's not just the chip problem; it's parts, generally speaking. And so, what companies are doing? I talked to a car dealer recently who told me that what the auto manufacturers are doing is they're building the cars that they make the most with the parts that they have that make the most profit. And so they're building the SUVs and the trucks.
Yep.
And they're not building sedans because smaller vehicles because they don't have the profit margin on those. And so if you have limited capacity, what are you going to build? You're going to
Yep.
build a product that has the highest profit margin, correct?
Yes.
Yeah. So
I know you're going to talk about it later, and it gets back to this whole transitory thing. I know you're going to talk about other factors as well, but we have to go back to the fuel thing because fuel prices drive inflation, not from the standard more money chasing fewer products, but just raises prices, and it raises prices universally. And for someone to say that inflation is transitory, they've got to have some idea that the increase in fuel prices is transitory as well. And I don't see it. And I don't. Policy is not going to change. It's going to allow oil prices to come back down. Although I know there's a supply chain issue in terms of that too, but
yeah,
policy is moving towards higher prices. It's just making the market. It's forcing the market to go higher, and when fuel goes higher, everything else goes higher. It's just the nature of the beast.
Yeah. So what we have to recognize, though, when it comes to oil production, is that during the pandemic, a lot of oil production went offline.
Yeah.
And so there is plenty of oil to be produced, but not enough rigs right now producing. And until prices get up to a reasonable level, it didn't make economic sense to put those rigs back online. And so it's a matter of replenishing that supply. And I think that we're going to see oil prices moderate. There's a bigger problem with natural gas, and it's becoming a major problem in Europe to the point where some manufacturers who rely on natural gas are not able to get supply. That's something to be aware of. It's affecting industries like fertilizers. Apparently, you need natural gas. They use natural gas in order to make fertilizers, and so in Europe they were having a problem getting gas, and a lot of supply is going to be disrupted as a result.
Is it the same problem of a supply chain ramp up again, or is it harvesting policy?
I don't know. I just heard the story this morning. I don't know what is at the root of this. My guess is it's probably the same problem. A lot of production went offline because you couldn't make any money. You'd go out of business if you continued to produce at that level. And so it's probably, again, just a temporary blip. But how long that is will affect the economy and probably push prices higher. So what's transitory? To answer your question, Lou, I don't know what transitory is, but I have a feeling that it's going to be more long term than what they are hoping it to be. Didn't
we talk on this show a little while ago? I've heard this principle before, but there is no scarcity, and it's one of these things is if there is enough money involved, so the price has to get to a certain point. I mean, we put a vaccine out in 6 months, Jeff. We ought to be able to ramp up oil production if there is enough profit to be had for the companies.
Oh, I agree.
Yeah.
And it's happening.
Yeah.
And it's happening. And I guess that's my point. I think that the big spike in energy prices is just temporary. That doesn't mean that is going to make everything great for inflation longer term. Now, keep in mind that we've been at a historically low inflation rate for the last 20 plus years, and so I would expect that inflation is going to be higher than it has been, higher in the next 20 years than it has been in the last 20 years. So I think that you need to keep that in mind, and I guess that's the point of the reason why I wanted to bring it up today is that if you're not factoring in inflation in your long-term financial plan, you're making a big mistake.
Yeah.
If you think it's going to be at 2%, I think that is a bad inflation rate to consider, and you probably should be targeting a much higher rate, both near term and longer term, in your financial plan. The Fed, just to kind of put some numbers to this, the Federal Reserve's target was 2% for the longest time.
Right.
And in mid-June of this year, they projected that their measure of inflation, which is different from CPI, keep that in mind, was going to be around 3%, which was higher than their target, substantially higher, but said that they would be willing to accept that because of these transitory factors, right?
Yep.
And then they said that it would be at 2%, 2.1% in next year, 2022. So
Oh, they got the crystal ball out.
that's what they do.
Yeah.
They get together, they all hover over the crystal ball and make their projections. Yes.
Throw some chicken bones in the sand and see what happens. Well, that's good. If it's going to be 0.9% less next year, that's good.
Yeah. Again, they're using PCE.
Yeah.
It's not the CPI number, which really I think is a better measure of what the average consumer is dealing with in terms of price increases. But the FOMC, they use their own number.
I'm sure they
to
do.
figure this out. Yeah.
Yeah.
Yeah. So again, bottom line is, I think that you should be definitely be factoring in inflation into your financial planning. And if you've been using less than 2% and not too worried about inflation, I think over the short term and then longer term, we should be factoring in a much higher inflation rate. And don't forget the effect that it might have on interest rates, because typically higher inflation means higher interest rates, and higher interest rates can have a negative effect on a lot of other investments that you have. So bottom line is you want to be diversified. And we should also mention that, or I want to mention this morning that the futures in the market, I think, just opened up. I don't know what the numbers look like right now, but the futures were pointing to a very negative open this morning, and we've had a few weeks of negative of declines in the stock market indexes, and I guess overseas they had having some bigger problems, and that's factoring in. So in addition to
September and go away.
Yeah, we did talk about that, right?
Yeah.
Last week, but it is getting a little bit volatile, and I did want to mention that. And if you've been watching the show for a while, I've been talking about diversifying into some alternative asset classes in order to better prepare for some volatility that I anticipate we're going to be seeing, at least in the short term. So did want to mention that, and we probably should take a break. We're going to talk a little bit about health.
Just so
health
you know,
insurance.
the S&P is down 1.43%.
Yeah, that's a big move in opening. That's a big opening move.
Down 63 points. Yeah.
63 points. Yeah.
Yeah.
So keep that in mind. And we're going to talk a little bit about high deductible health insurance plans and what it means to you, and how maybe you can benefit from that type of a plan, and how you can save some money maybe on taxes as a result. So we're going to take a quick break. Stay tuned. We'll be right back.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back. So, hey, Luke, can you just do me a favor? And I was just looking at the market indexes.
Yes.
Can you do me a favor and tell me what you see on your
For any particular index?
S&P 500?
S&P 500 is down at 935 this morning. 62 down 62 points, 1.41%.
So is that delayed somehow?
That's delayed, I would imagine.
Yeah.
Yeah.
So I'm looking at a different number. I just wanted to compare it to what you had up there.
It's just the Wall Street
Yeah.
Journal public, so I'm guessing it's delayed.
Yeah.
Probably
Okay.
15 minutes or so.
All right. Yeah.
What did you get?
Yeah, I got down about 400 points on the Dow, 45 on the Standard & Poor's 500.
On the Dow, I
46.
have down 530 points, 1.5%.
That's interesting.
Yeah.
I'm not sure which direction it's going in here. That's all. That's why I asked. All right. Well, so again, if you've been watching the show for a while, I've been talking about
It's gone up
diversifying.
since it's rebounded since this morning at 8:25.
Yeah. Okay.
Yep.
And just diversifying into maybe some alternative asset classes to be better prepared, better positioned for volatility. I mean, we've been riding the stock market wave for the last couple of years through the pandemic and into this year. You might get complacent. I don't think that's a good idea. This might be a good time to be rebalancing, despite what happens today. So I want to take a few minutes and talk about health insurance.
Mhm.
And I'll start by mentioning a couple of things here that about if you're lucky enough to have a group health, you're working for a company that has a group health insurance plan that is paying most or all of the premiums, and they give you the platinum, the blue chip plan. You probably don't think about these things too often, but that's not everybody. And so this is for those people who don't have access to, or their company doesn't provide, a super duper group health insurance plan where they're paying most or all the premiums. That is, even some bigger companies are starting to rethink how they offer or what sort of health insurance benefits they offer, because prices have been going up, the costs have been going up, and so they're starting to rethink those plans and putting more of the cost on the employees or giving them an alternative like a high deductible health insurance plan, right?
Mhm.
And so about the most common plan covering about half of U.S. workers is what they call a preferred provider plan. So a preferred provider plan is a plan where you have a network of doctors that you use. As long as you use that network of healthcare providers, physicians, clinics, other specialty surgeons, that sort of thing, then you get the best possible benefit from using that network. But PPOs do allow you to work outside the network, and typically you don't get the same level of benefit. You might actually have to pay something in order to use someone who's outside the network. But a lot of companies have these high deductible health insurance plans, and in 2020, about 31% of workers had high deductible health insurance plans, and that's up from 24% in 2015. So you can see the trend there is starting to go towards different types of plans. One where the employee is paying more out of their pocket, either because the premiums are going up on the plans that they have, or the alternative, a high deductible health insurance plan, they're paying more out of pocket initially. And so how it works is this. And in fact, you might actually be better off with a high deductible health insurance plan, whether your company offers it or you're buying it independently through, let's say, the marketplace, right?
Yep.
And in fact, through the marketplace, that pretty much is your option, is some sort of a high deductible health insurance plan. And so the way it works is, in return for lower premiums, you pay more out of pocket for medical services. It typically has an individual deductible. Let's say for a family, each person has a deductible before the insurance company pays a dime.
Right.
Once you reach that threshold, typically they're going to pay, 100%, or maybe there's a co-insurance depending on the type of plan that you use. And then if you have a family plan, then there typically is a family out-of-pocket maximum.
Right.
So you pay more as a deductible initially, just like your car insurance, right? You get into an auto accident,
Sure.
pay a deductible. And then the insurance company pays after you reach that threshold. And typically they'll have a family out-of-pocket maximum, where once all of your expenses in a single year exceed a certain amount for the whole family, and then you've met your deductible for everybody else in the family as well. And the out-of-pocket costs cease as well. And then you're covered for 100%. Again, as long as you're using the network that is provided to you.
Right.
And the reason why that works, by the way, is because the insurance company has negotiated prices for services with the healthcare network that they've put together. And so the healthcare network is willing to accept a certain price, knowing that they've got all these people that are going to be using their services. And so with a PPO that is not a high deductible health insurance plan, typically what you have is you have copays.
Right.
Instead. So instead of a deductible, you have copays, including prescription drugs. Right.
Right.
And so with a high deductible health insurance plan, you're paying out of pocket until you meet that threshold, that deductible. You are, with a PPO, you're just paying a copay, like $25 per doctor visit, or so much if you go to the emergency room. Typically, those plans also have out-of-pocket family maximums as well, but generally speaking, they're going to be a higher cost to you to have that plan, a higher cost to your employer, and typically, even if you are paying a portion of it, it's going to be higher than if you chose the high deductible health insurance option that your company may be offering you. And not all companies have multiple plans to offer, so you have to be aware of your particular benefits. If you're self-employed, that's a whole different bag, and because of the healthcare, what they call that, the healthcare reform. What was that? What was it? What was the name?
Obamacare.
Obamacare for short. I was looking for the official name, but yeah, because of Obamacare, they pretty much destroyed the private market for health insurance, because they put in all these mandates.
I had lost track of what stayed and what didn't, but I was kind of surprised that you could actually offer different. I thought there were only about 3 types of healthcare plans available to you.
Yeah. So all those plans now are really high deductible health insurance plans. And so beyond just the the savings that you get if a high deductible health insurance plan works for you, because the premiums are lower typically. If you're healthy, by the way, if you're healthy, your family is healthy, having a high deductible health insurance plan with a lower premium cost might actually be the better solution for you.
Right.
Because if you're not using the services, why pay for them, right?
Yep.
Yeah, and put that money back in your pocket, or consider taking that savings and put it into a health savings account, or HSA for short.
Right.
And so an HSA is like an IRA, basically, for medical expenses. And what you can do with an HSA is you can put money into it. You can actually invest it, Lou. A lot of people don't realize that you can actually invest it. That wasn't me. That was
me.
That was okay.
Don't worry.
I got everything shut off. So what you can do is you can put money into these health savings accounts, and as I was saying, you can actually invest it in mutual funds if you wanted to make it grow, and you use that money to pay your medical expenses. The money goes in pre-tax, so you don't pay federal or state income taxes on it. And when you pull it out, as long as you're using it for qualified medical expenses, you don't pay taxes when you pull it out. And so here's a
break. Yep.
Here's a way to take that premium savings, throw it into a pre-tax plan, and then pay for your out-of-pocket medical expenses, your high deductible, out of the plan, saving you a substantial amount depending on the cost, right? Saving you money in taxes, and also giving you a vehicle to pay expenses in the future as well, and let that money grow.
Okay, I'm going to assume that healthcare premiums are deductible expense.
Correct, and that's a great health. No, I take it back. So here's the thing: healthcare expenses.
Health insurance premiums.
Health insurance premiums. Health insurance premiums are a deductible expense to an individual. If you're paying those premiums through your employment, typically it's part of a cafeteria plan, which essentially is a pre-tax payment. So you're not paying taxes on it, and you can't deduct it because you didn't pay taxes on it, right? But if you're an individual and you're paying out of pocket and you're not paying through your employer's plan, then you could deduct it on your tax return. However, you have to have total medical expenses, including your insurance premiums, that exceed 7.5% of your adjusted gross income. Otherwise, you don't get a deduction at all. So so it's the first dollar that goes up above that threshold is deductible, and every dollar above that. But until you get there, you don't get to deduct it at all. So an HSA is much better than taking it as an itemized deduction.
Right.
And when we factor in the standard deduction, all of a sudden deducting medical expenses is not as beneficial as it once was. And so a health savings account you can avoid paying taxes on the money you put into it. Your employer can make contributions to your plan as well. And a lot of times employers match up the high deductible health plan with an HSA plan that they install as a benefit and make contributions to it. I do have a slide, Lou, that shows the maximum.
Let me ask this follow-up question, if I can. I'll be this guy. Can you pay your health insurance premiums with your HSA?
Can you pay your health insurance premiums with your HSA? That's a great question. I think you can, but I'd have to check just to be sure.
Yeah.
So don't take that as gospel.
Right.
Let me look that one up, and I'll get back to you on that. Okay.
Yep.
And so that would be a way of that would be a way of essentially deducting your health insurance premiums by putting the money into the HSA and then reimbursing yourself for those health insurance premiums, and you avoid federal and state taxes on it. Yeah, that's a great point.
If it's a qualified expenditure of the HSA, expense of the
Right.
HSA.
Exactly. And so I want to show you the amounts you can put into an HSA. This is for 2021 and then 2022 because it is adjusted for inflation.
Mhm.
For individuals, it's $3,600 a year.
Mhm.
That's for this year, $3,650 for next year, and you don't have to take it. You don't necessarily have to pay that every month. So you can put the whole $3,600 in before the end of the year. You can actually fund it up to April, just like an IRA, if you
Okay.
wanted to. And then it's $7,200 this year for a family. And if you're 55 or older, then you can put another $1,000 in as an individual or as a family. So everybody who's over 55, you can add another $1,000 to that. That's a nice chunk of money. And if you're not using it to pay your out-of-pocket medical expenses, it rolls over to the next year and continues to grow. And like I said, you can actually invest that money if you want to. By the way, if you're once you reach Social Security retirement age of 65, or I should say Medicare, once you reach Medicare age 65, you can no longer make contributions into your HSA. But here's something that a lot of people don't realize is that you can actually take your HSA plan and roll that over into an IRA account once you
That's
reach
what I
that
was wondering.
magic age,
Yeah, what's the magic age?
65.
65.
You can't add it to it anymore. So basically, they say, hey, you can if you want to. I mean, you can pay your Medicare. You can pull money out and pay your Medicare premiums with it. I know that for sure.
Yeah.
Or you can actually turn it into a retirement or into a retirement account for yourself.
That's what I was wondering, because especially with young people,
With
if they're
no penalty.
paying into this HSA, they're going to be accumulating a lot of money in here that is going to be tied up for medical expenses only, which they may not pay.
Right. Exactly. Right.
Yeah.
And so here's a way to build up a supplemental retirement plan that actually has the ability to access it to pay your legitimate medical expenses prior to retirement,
And it would
or even in retirement for that matter.
And is managed investments like a typical IRA, for example?
Correct.
Yeah.
Yep. Yeah.
Interesting.
So if you already have a high deductible health insurance plan, this is available to you. If you're thinking about maybe going to a high deductible health insurance plan, consider the fact that you can make contributions to an HSA because you have one. And you can only do an HSA. Look, you can only do it if you have a high deductible health insurance plan.
I was going to say
that is a prerequisite.
Okay, so you're disqualified if you have a health insurance plan with a
Correct.
reasonable deductible or a regular deductible.
Correct.
Oh, interesting. Yeah.
Yes. Yeah. So if you have any questions on that, feel free to get in touch with me. I'd be glad to discuss it with you, and we could make that part of our initial consultation.
Excellent.
Hey, look, let's take a break. We're running a little bit late. I do want to get to the last item today, and that is today's or this week's Talk Money tip, and it's all about net price calculators. So if you have, like I said, if you have a student, if you have a family member, son or a daughter who's in their senior year of high school, they're college bound, you definitely want to learn about net price calculators. So we'll take a quick break and we'll talk about that when we get back.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Welcome back to Talk Money. Hey, so fall is the time when a lot of high school seniors are narrowing their college lists. And if you have a son or a daughter in high school that's college bound, you've probably been looking at some of their interests, what colleges they might be interested in. And if you're trying to figure out how you're going to pay for it, you're probably you might be suffering from sticker shock.
Yes.
When you look at the costs, absolutely incredible how much some colleges want you to pay for 1 year of college education. But that's it. And in a lot of cases, you've told your son or daughter, hey, if you get the grades, we'll take care of we'll pay for it. And now you might be regretting that.
Yeah.
that statement at this point.
I'd advise against that, but yeah.
So here's the thing that you need to know, right? The sticker price is not necessarily the price that you pay.
Oh,
right?
Yes.
And why is that?
Well, you have financial aid, federal financial aid.
Right, exactly. Financial aid, right? And so what you want to do is you want to get a hold of a net price calculator. So a net price calculator can help families measure a specific college's true cost. That's what so when you start comparing colleges, you want to compare it based on the true cost.
Right.
That you're gonna pay, not the sticker price. Because depending on your circumstances, it may cost you a lot less to go to one college over another, based on the history of the financial aid that the college is willing to provide, right?
Yep.
So what you need to know is what that net price is, and most colleges now on their websites are including a net price calculator right on the website. So you want to find that net price calculator in order to come up with the true cost of that particular college. So when you put it into your spreadsheet and you start comparing each institution and the ultimate cost over the next 4 years, you want to use that net price. You don't want to use the headline. We'll call it the headline price.
How does it supply?
Board.
How does it supply the amount of financial aid? Is that after?
That is a great question. That's a great question,
What
Lou.
I do, Jeff. Yeah.
I would imagine. I would imagine that some colleges might use an average.
Yeah.
Right. But what you want the net price calculator that actually asks you some questions. Right. And so they're going to ask you about your income. They're going to ask you about your assets. They're going to ask about the student's income, the student's assets. Right. Mm-hmm. They'll ask about the general academic record, family side, including dependents. So all of those factors feed into what ultimately the institution might be able to offer for financial aid. It's not a guarantee, and by the way, don't be hesitant to put that information in, because basically it's anonymous. They're not going to connect you with any application for student aid. So be honest with the numbers so that you get a true evaluation of how much financial aid might be available. And what you're looking for is grant aid, obviously, the kind that you don't have to pay back.
Right.
So if it throws in work study, for example, or student Stafford loans, that's not what you want. You don't want to factor that in. Although it's available and it will help you to pay for education, it's not something that you want to factor in when you're comparing one institution to another in terms of its overall true cost.
So if the institution, you say most of the institutions have a net cost calculator, or
right on their website.
Yeah.
Yep.
So,
yep.
But
yep.
if the institution doesn't, are there alternatives?
There are alternatives. Again, another great question, Lou. We do have the ability to help you out with that because we have systems that allow us to that have a database of all that information, so we can actually run a report that shows, you just give us the schools that you're looking at. We can run a report that shows what those net prices are for each institution based on the same criteria.
Right.
Income, assets, academic record, all feeds into that, and we can come up with a report that shows you that result.
And I'm guessing that using one institution's net cost calculator to estimate another's costs is probably folly, because each institution has different policies for institutional financial aid.
Well, that's true, but if you're giving them the same information in each instance,
It's going to be similar.
it's going to be similar.
Yeah.
Yeah, and I think it would be so if you're saying that you shouldn't do it yourself, I can't say that. I think that if you have if you take the time and find that information, find that net price calculator on the college's website, I think it would be a good start anyway.
Yep.
It would be a good start.
Give you a good idea. Yeah.
Yeah, absolutely. So you want to consider the net price, the price that you're actually going to pay, not the headline price, because hey, colleges have endowments, money that they want to spend.
They certainly do.
And so, and I would add this too: don't assume that you won't qualify for financial aid based on your income and assets, because you never know. And there are things that you can do to reposition assets and maybe even affect your income for financial aid purposes that will make it allow you to take advantage of the financial aid system, the money that's out there.
All right. Excellent.
Yeah. So, hey, if it looks like we're pretty much done for today, Lou.
Yep.
And before we go, I do want to mention again that we do have a no cost, no obligation initial consultation. We can do that over Zoom, so you don't actually have to travel out to the office. And if you want to get in touch with me after the show, schedule that, or you have some other question, feel free to give me a call. Use the toll-free number, 877-475-2062. Or you can just send me an email. It's jeff@talkmoneyradio.com, or just send us a message on the Facebook page. And please do, if any of this information has helped you out, please like us. Just push the like button there and share it with your friends and let them know all about it. And did want to mention one other thing. What was that? Oh, the library again. I just want to mention the library again. There's so much information there. We've been doing this for a while, Lou. We've got all these recordings in the library. I venture to say that there isn't some aspect of personal financial planning that we haven't covered over the last couple of years. So you might find it in the library. So take a peek.
All right.
So thanks, Lou. We'll see you next week. Same time here on Talk Money. And remember, in the meantime, good sound advice is much better than advice that just sounds good.